At the time of this recording, it is Saturday, December 6th, 2025, and the markets are closed for the weekend, leaving investors in Datavault AI, Inc., ticker symbol DVLT, staring at a frozen dashboard that tells a brutal story. The stock closed the Friday session at exactly $1.70 USD, suffering a significant intraday decline of 16 cents, which translates to a sharp 8.60% drop. While the after-hours market attempted a meager recovery, ticking up 1 cent to $1.71, that tiny green flicker does little to offset the heavy red candle that dominated the day's trading. The session opened at $1.89, briefly tested a high of $1.91, and then succumbed to relentless selling pressure, grinding down to the $1.70 lows by the closing bell. When you look at a chart like this, the expectation from the retail community is almost always one of immediate resilience. The belief that a company pivoting from legacy audio tech to the high-octane world of Web 3.0 and AI data monetization should be immune to this kind of relentless gravity. Investors see the AI in the name, they see the press releases about data valuation, and they expect a vertical line to the right. But the reality, as we are seeing on the screen, is far more complex and punishing. The market is not paying for promises this week, it is punishing execution risks and dilution fears. The gap between what the press releases say and what the order book shows is widening, and that is where the danger and potentially the opportunity lies for those willing to look past the surface. This Friday sell-off is particularly damaging because it breaks the psychological support that had been building around the $1.80 level. When a stock like DVLT, which has seen a 52-week high of $4.10, finds itself languishing at $1.70, the narrative shifts from buying the dip to catching a falling knife. The volume we saw on Friday was significant, indicating that this wasn't just retail panic, there was likely institutional distribution or a coordinated exit by larger players who decided not to hold risk over the weekend. The chart shows a classic fade pattern, a hopeful open that traps early buyers, followed by a systematic walk-down of the price, squeezing out stop losses at every key level. Let's analyze the intraday action because it tells you exactly what the smart money was doing. The stock opened at $1.89, just a few cents below the previous close of $1.86. No, wait, the previous close was at $1.86. The open was actually higher at $1.89, a gap up that often baits amateur traders into thinking a rally is starting. They see green at 9:30 a.m. and hit the buy button. But notice the high of day was only $1.91. That means within minutes of the opening bell, the buying power exhausted itself. The bulls could not push it past $1.91. Once that momentum stalled, the sellers took control and they never let go. The price didn't just drift, it was pushed down to $1.70, closing at the absolute low of the day. Closing on the lows is a bearish signal. It means that even at the final seconds of the trading day, no one stepped in to say, "This is too cheap." Instead, traders were hitting the bid just to get out before the weekend. The context here is crucial. Datavault AI, Inc. is the result of a massive pivot, a rebrand from Wiza Technologies, a company that dealt in wireless audio, to an entity focused on the valuation and monetization of data in the Web 3.0 economy. This is a story of transformation, but transformations are messy, expensive, and fraught with skepticism. The market is currently weighing the expectation of this new business model against the reality of the company's balance sheet. The expectation is that Datavault will become the central bank of data, allowing companies to value their data assets like gold or currency. If they pull this off, the current market cap, hovering in that volatile range between $65 million and $485 million, depending on how you calculate the diluted share count, could be a fraction of its future value. But the reality is that building this infrastructure burns cash at a terrifying rate. And the market is terrified that the only way to keep the lights on is to print more shares, diluting existing holders into oblivion. This brings us to the critical topic of short selling, which is a massive driver of the price action we are seeing. You cannot look at a drop of 8.60% on no major specific news without suspecting short seller involvement. In the modern market, stocks like DVLT are battlegrounds. I want you to check the short borrow rates for DVLT next time you're on your brokerage platform. We have seen reports of borrow rates spiking into the double digits, sometimes hovering around 15 to 20% or even higher during peak volatility. When the cost to borrow shares is that high, it means two things. First, that everyone wants to short it, and second, that there are very few shares left to borrow. This creates a powder keg scenario. If the short sellers are right, the stock goes to zero or undergoes a reverse split to stay compliant. But if they're wrong, if Datavault drops a piece of substantial news, like a verified revenue stream from their new data platform or a finalized tranche of investment that doesn't crush shareholders, those shorts are trapped. They have to buy back shares to cover, and they have to pay high interest while they wait. This is the squeeze setup that keeps retail investors hanging on. However, you must be careful. Hoping for a squeeze is not a strategy, it is a gamble. You need to watch the fails to deliver data. When FTDs pile up, it suggests that naked shorting might be occurring, or that liquidity is so thin that brokers can't locate shares. This artificial supply depresses the price, as we saw on Friday. Right now, the bears are in control. They see a company with a history of losses, net margins in the negative thousands% range historically, and they are betting that the AI rebrand is just lipstick on a pig. They are attacking the $1.70 level because they know if it breaks, the next support is likely much lower, perhaps testing the $1.50 or even that catastrophic 52-week low of 0.25 cents. Yes, you heard that right. This stock has traded at a quarter within the last year. The rally to $4.10 was spectacular, but the round trip back down is painful. I want to pause here and ask you a question because this community's sentiment matters more than Wall Street analysts right now. Comment below. Do you think the rebrand to Datavault AI is a genuine strategic shift that will dominate the data economy, or do you think it's a desperate attempt to ride the AI hype cycle? I want to know if you are holding shares through this drop or if you cut your losses on Friday. Let's look closer at the reality of their business model, because it is fascinating despite the stock's performance. Datavault AI claims to offer a dual platform approach, the legacy acoustic science division, the old Wisatech, and the new data science division. The acoustic side is the boring part. It's wireless audio for home theaters. It's a real business, but it's not a high-growth engine. The data science side is the expectation engine. They are building tools like Datavault, Data Value, and Data Score. The pitch is that in a world of generative AI, high-quality, verified data is the most valuable resource on Earth. Companies have vast silos of data they don't know how to value or sell. Datavault wants to be the appraiser and the marketplace for that data, using blockchain to secure it. It sounds incredible on paper, but the reality check is execution. Who are their clients? How much revenue is this specific division generating today versus the old audio business? The recent earnings reports have shown massive revenue growth, some figures citing 148% year-over-year increases. But this is often coming off a very small base. If you make $10 and then make $25, that's huge percentage growth, but it doesn't pay the millions in salaries and server costs. The net loss of roughly $33 million reported in recent quarters is the number you need to stare at.
You cannot sustain a $33 million burn rate indefinitely when your market cap is under pressure. This is why the dilution word keeps coming up in forums and chat rooms. To plug that $33 million hole, they have to raise cash. If they sell stock to raise cash, your slice of the pie gets smaller. The Silex investment is another massive piece of this puzzle. The headline number of $150 million was thrown around, and that got everyone excited. But the details are in the details. These deals are often structured in tranches, meaning the company doesn't get a check for $150 million on day one. They get it in pieces, and often those pieces are tied to milestones or stock performance. If the stock drops, the terms of future financing can become toxic, forcing the company to issue more shares at lower prices to get the same amount of money. This is the death spiral risk that veteran traders are watching for. The drop to $1.70 might be the market pricing in the fear that the next tranche of funding will be expensive for current shareholders.